Hi, my name is Rose Dunn, realtor with EXP in the state of Texas. I am here with again with Miss Julia Davis. Welcome back, Julia. So today
Hello.
we are going to talk about a conventional because I know the last time you mentioned conventional,
Mhm.
and I'm going to let you introduce yourself and talk a little bit about you, and then we'll move forward.
Wonderful. Well, my name is Julia Davis. I am with Guaranteed Rate. I have been in the mortgage industry a little over 20 years, but let's just say 20 for the moment. I mean, I do all types of loans. So whatever it is, definitely ask because we do all kinds of loans. But today I know we're going to focus on conventional.
Yes. Okay. So most people, whenever they start looking for a home, they do not talk to a lender. They wake up, they say, you know what, I'm tired of renting. I'm just going to get a house. And they start looking online and they when they start looking, they see a home and the home say, oh, that's $1,300 payment. And they don't realize it's just for the principal and interest based on a certain type of credit. So can you go a little bit over the conventional compared to the FHA? We know the history of FHA. So what about conventional?
Well, conventional loans are basically they're insured by Fannie Mae or Freddie Mac, which I think is a two names that you hear a lot about in the news.
Yes.
So basically, they provide the guidelines for us to be able to offer the loans, and so it's our job as lenders to follow those guidelines to make sure that the loans are insurable. So those are conventional loans. They do start with a minimum credit score of a 620,
Mhm.
and again they're available to pretty much anybody who can qualify for them. um, Specifically, and again, I don't know how much I'm talking too much about a certain thing before you ask your next question. But basically, conventional loans are going to be looking for more credit history. They want a stronger credit history. So they want to see, more trade lines, meaning credit, any credit cards, any student, any loans, car loans, house, whatever payments that you've had for more than 12 to 24 months. They do want to see a little bit more history. They don't like a lot of derogatory things on conventional loans.
Mm. So let's say somebody who just like started, someone who always use cash and they want to buy a house, they just started their credit history. For example, someone who just go to one of those small bank and get a starter credit card and it's been
Mhm.
1 year. Is it going to be difficult for them to get a conventional loan or
More than likely.
okay?
I mean, they can probably still qualify with an FHA loan, but if they don't have a lot of history with more than one type of credit,
Mhm.
for more than a year to 2 years, they're looking probably more for 2 years of history. And again, each credit is a little different. Each person is a little different because it does look at compensating factors, which are, how long have you been on your job? Are you putting huge down payment? Do you have a lot of money left over in reserves? But for the most part, it's still going to require that you have some sort of stable credit history that they can really look at and make a good decision on.
Mhm. You say something about reserve. So, what is the minimum down payment for conventional? Because I've seen some advertisement, and I know the consumer has, as a realtor, I've seen it, and consumer come in, they ask questions, say, "Hey, I know I can do 3% down payment for conventional. Can you touch based on that? What's the minimum down payment for
Mhm.
conventional?"
Yeah, they do have first time home buyer conventional programs. And there are some that don't need to be first time home buyers as well. And they do have a 3% minimum down payment. So depending on credit, in this market currently, if you can qualify for a 3% down, your private mortgage insurance, which is something we'll touch on in just a second, it will usually be less than what you're paying for if you were to do an FHA loan. So it is a great program. And again, it's lower down payment. FHA is at 3.5%, conventionals at 3. And you can use certain programs if you are a repeat borrower. However, there are some of those programs as well that do have uh, income requirements or restrictions. So, you just we'll go through those and see which ones you fit your bucket. If a 3% down program doesn't work, you have the option of doing a 5% down. Again, you can put as much down as you'd like. The bank is happy to take your money.
Yeah. In the street, most people they say, oh, for you to get a conventional, you need 20% down payment. So does the credit play a part on the down payment?
Well, it does. So, what we're looking for is where we get into debt to income. Okay. So debt to income basically means how much of the money that you're making, your gross income, is going towards debt. Debt is being the items that you have on your credit report plus a house payment. And there are certain guidelines that we have to go off of, that we can't exceed a certain percentage of debt with a conventional loan and any type of loan. Okay. So if you want a higher priced home and you don't have sufficient means on your debt to income, putting an extra down payment or more down payment can definitely help to get you into what you're looking for. We also have means to look at maybe paying off something on your credit to help you qualify. But the myth I've heard a lot of people as well call and say, oh, I didn't think I could do a conventional loan because I don't have 20% down. So basically, where that comes in is that most people, if they've read up on anything about conventional loans, if you put 20% down, you can waive private mortgage insurance. So private mortgage insurance is basically insurance that is placed on the loan by the insurer of the loan to make sure that you're covering or you're paying the loan. So if you default on that loan, the agency has some sort of recourse to not lose all their money in that transaction. So, and that's just a real quick summary of what it is. But when someone puts 20% down on a conventional loan, they don't have that additional cost of the private mortgage insurance. There are other ways for them to either lower their private mortgage insurance or to pay a fee ahead of time to get rid of it. And those are things that are case by case basis. And, we definitely look at those based on the individual and what they have.
Okay. So let's say somebody doesn't have 20%, they put 3% down,
Mhm.
5% down, 10% down. When does the um, private mortgage insurance will be removed on the loan? Can you elaborate on that?
Absolutely. So the private mortgage insurance by rule will automatically fall off when they get to 78% of the loan amount. So they'll base it on what you purchased it for plus your sales price or your loan amount. And then once you get to 78% of that, they will automatically remove it. However, in this market, as we can see, the prices of the homes have been going up quite a bit. So if you know that your property is worth a lot higher, and your loan amount is now 80% of that value, you can definitely talk to your lender about reevaluating your mortgage to see if they can remove that private mortgage insurance. So you can request it to be removed once you've gotten 20% equity in your property, either whether you've paid it down 20% or the home has increased 20% or a combination of the two.
Hmm. That's interesting. But a lot of people have FHA loan. I know we touched that on previous video. However, let's say somebody is in the 80% bracket for an FHA loan. Can they find out? Is it easier to find out how to refinance to get a conventional so that they don't have to pay the private mortgage insurance?
No. So the question is, if they have a current FHA loan,
Yes.
they have the 20% equity, FHA does not remove private mortgage insurance. So yes, they would have to refinance to a conventional loan in order to remove that private mortgage insurance. And basically, it's just a call to your lender. We're going to do the same thing that we do when you purchase the home. We're going to do a full application. We're going to look at your income. We're going to look at the value of the property and your debt to income. So it's the same process, but definitely start there because, that's where you're going to need to go to get the financing and to get that removed.
Yeah. So you touched something earlier. You're talking about DTI. So
Mhm.
can you go over the DTI? What is the percentage? Because we know some not everybody make a lot of money, and a lot of people have student loan. They have car notes. What is the DTI ratio have to be?
So it depends on the program. So some of these first time home buyer programs, we've got, Home Ready, we've got Home Possible with Freddie Mac,
Mm-hmm.
even the Home One program. Some of these conventional loans for those types of programs will allow you to go up to around 50% debt to income. However, the traditional answer to that for a regular typical conventional loan is around 45, 46%.
Okay. Hmm.
So basically that means 40, let's say if we're going with a 46% of the income, your gross income cannot be, that's the maximum amount you can use in total debt.
Okay.
Okay. So that would mean anything that's listed on your credit report plus the house payment and HOA if applicable cannot exceed that percentage. And again, it can go higher with those programs. It just depends on, which ones we get into with that particular borrower.
Okay. So are those programs considered down payment assistant? Is there a catch to it? What's the catch?
Oh, no, the down payment assistance is completely different than a
Okay.
first time home buyer conventional program.
Yeah.
Yeah, so that we'll do that on another call.
Okay. We'll do that.
But
Okay.
yes, both it does allow you to do assistance if there is if you qualify for it, of course.
Okay. So let's touch something about we know with FHA you cannot get home that is not ready to move in. So what about conventional loan?
Conventional loans are a little bit more forgiving.
Okay.
If there's, of course, in either home, if there's cosmetic things, cosmetic being the paint needs to be redone, the carpet's a little shaggy, needs to be replaced.
Mhm.
Those are cosmetic type items.
Okay.
Conventional loans, if somebody got mad, punched the wall, they don't care so much about certain things like that. Those are cosmetic things. Of course, with either loan, anything that is a safety hazard will probably be a concern. Safety hazard being, the roof is caving in because, there's a leak. Or, there's flooring popping up that may cause someone to trip and fall. If there's exposed wiring, and that's with any loans, those are things that would be a safety hazard.
Mhm.
But conventional loans are not as picky as a FHA loan about it being completely, spotless or home, ready to move in. So you will see some people, put on there that, I want conventional loans only because, I don't want to have to do any, repairs that may be minor. So that would be the difference pretty much when it comes to, conditions between the two.
Okay. No, because sometimes you see advertisement with the iBuyer, they'll say the home is not qualified for FHA, but it's qualified for conventional loan. What is the guideline in that? Can you?
Yeah, well, sometimes what you're gonna see is that, especially in this market, we have a lot of investors that are purchasing homes right now,
Mhm.
and they're renovating them. And if they're renovating them and they're putting them back on the market, one of the things that you have to be cautious with is with a conventional loan, we don't have a waiting period per se for them to be on the title as much as we do with FHA. As we spoke about previously, FHA, your borrower has to wait till the 91st day that the seller actually owned the home.
Mhm.
And with conventional loans, you don't have that issue. So
So I was asking about investors whenever they do flip. For example, a big company like Open Door and Zillow, they go and they buy the home off market without an appraisal, and you have investors that buy home and they do um, have an appraisal. So I'm not sure. I know you are not an appraiser. So, but I just want you to touch a little bit, like what's the way that to protect the consumer from buying a house that is overpriced and after it
Well,
flip.
yeah. Well, of course, when an investor is buying a property, they're if they remodel it or do anything to that effect, they're definitely anticipating that it will sell for a certain percentage, right? So we as the lender, we are going to order our own appraisal. We're going to verify that it is, in effect, it is worth what we're saying it's worth. So they're looking at, the appraisers are basically looking at the price per square foot. They're looking at the market. They're looking at sales that have sold, other homes that have sold in that area that are close to or similar to the home that you're currently purchasing. They're looking at the number of bedrooms. They're looking at how many bathrooms, what the fixtures are. Fixtures being that, somebody updated it versus somebody who still has, 1970 fixtures in the house. That will make a difference on your value. Is it a newer roof? Those are huge. Does it have a pool? Different things like that. The appraisers are going to look at. But as a lender, we will not lend on more than what it's worth. So if by chance you're purchasing a home and the appraisal value comes in higher than what you expected, then that's fantastic. You have equity built into your home. However, if it does come in lower than that, then two things usually happen. One, you're either going to negotiate via your realtor with the seller to bring the price down to whatever that sales price is, or two, you will be responsible for paying the difference of that sales price versus appraised value. So, just be aware that's a thing. It does happen in this market, and you just, have to be prepared.
Yeah. I know we already talked about FHA on previous video. So let's say if it was an FHA loan, can they still bring more money to cover the difference? Because in today's market, that 2021, since COVID started, we see the market has changed. Home
Mhm,
value has increased tremendously. People are sending offers 20,000, even 50,000. They don't get the home, especially in the luxury market where they send an offer at 100,000 and they still didn't get it. Does
mhm.
it make a difference if the loan type was different than FHA?
I mean, the big thing is really how much money does the customer have?
Okay.
Because at the end of the day, if they really want that house and they're offering 20, $50,000, whatever it is, above the price, um, they technically need to be prepared to pay that money on top of whatever they're doing. So like we were talking about earlier, depending on the program they're in, they can do little as 3% down.
Mm-hmm.
So let's do an example of, let's say 250. Okay. So if the sales price is 250, but the let's say the appraisal report came in at 245. If the seller does not want to reduce the price of the house, then that borrower is responsible for paying 3% down of the 245,000 that it's worth,
Mm.
plus the additional 5,000 on top of that. So yeah, I have seen in that market where some people are overbidding just to win the house,
Yes.
but then they don't have the finances to back it up should that house not appraise for that amount. And of course, it depends on the seller and what you're willing to give up. But again, it's you can negotiate, maybe meet them halfway. But I would always tell people, if they are going to bid over, Be prepared as to whether or not the house is going to appraise. And of course, the best person to kind of guide you is your realtor. Because, as a realtor, you can actually see comparables in the market. You can guide your clients
Mhm.
as to whether or not, we think the house may appraise for X. And that way, if they make an offer, there's a pretty good chance that it might go for that price.
Yes.
And if not, then again, they just need to be prepared financially to cover the difference if that comes back unfavorably.
Okay. So let's say the consumer has money for down payment and they didn't have the fund to cover the difference. Can they receive money from family member, a sugar daddy, one of those, you know,
I don't know about the
friendly
sugar daddy.
benefits?
Yeah, so gift funds are pretty much defined as a immediate family member.
Mhm.
So we're looking at mom, dad, we're looking at grandparents, we're looking at siblings, brothers, sisters, even aunts and uncles. They don't necessarily like cousins,
Mhm.
fiancés, if you can prove you are fiancéed. Basically, a fiance would have to be somebody who are you're on, let's say, the rent together. You guys have a lease together, or you are sharing a debt together. Then maybe we have a chance there. But it's pretty much for immediate family. We'll just keep that in a nutshell. There are exceptions to certain things, but again, we'll go individually to figure that out. But anytime your family is giving you any sort of money, of course, talk to the loan officer first, because number one, in the case of conventional loans, anything above 50% of your income that is deposited and it's not your payroll, we are going to we need to verify and source it. That means we need to know where it comes from. So you can't just have your mom, go deposit $5,000 in cash into your account, because we can't source cash.
Mhm.
Of course, unless, she immediately withdrew it the same day, it went into your account the same day, and we can trace and track it. Those are very specific circumstances, but they don't like having large cash deposits. So always talk to your loan officer, make sure you know how to deposit things properly, make sure it's documented. And that way, you don't get yourself in any trouble.
Mhm. Okay. So what about, grandparents now play a big part on children's life. What about grandparents? Can they still help?
Of course. Yeah. I mean, grandparents can help as far as, are you talking about just the
The gift
payment portion?
yes, the down payment
Yeah.
options.
Yeah. I mean, they're immediate family. So yeah, they can definitely help.
Okay. So, what about like people that have student loans? So, when you talk about the debt and conventional is student loan that are in deferment. So, how is the guideline go with conventional?
Mhm. So conventional loans are also, again, a lot of people are in deferment right now, basically meaning that when we pull your credit report, you're showing a zero payment. Guidelines do allow us to, we do have to count a payment, because at some point you are going to be making a payment on that
Yes.
student loan. And so they are at 0.5% of the loan amount, or the balance of your loan, is what we use as a calculation to calculate the payment on that particular loan. Conventional also allows anybody who's in a payment or a repayment plan based on income. So an income-based repayment plan, they will allow the payments on those as well. FHA does not, but conventional will allow you to use an income-based plan. And the reason with the income-based repayment plan is it can change from year to year,
Mhm.
depending on your income. But conventional loans do allow that. So 0.5% of your balance is what's counted as a payment when we're calculating your debt to income with student loans.
Okay. So, is it easier to get a conventional loan compared to other type of loan? let's say FHA, VA. I mean, if somebody's a VA, we know we're not going to touch that. But
Mhm.
like USDA, FHA, even in investment loan, is it easy?
Yeah. Now, I don't want to say
Hmm.
the guidelines on FHA are a little bit more loose.
Okay.
So conventional loans do want a borrower who has solid credit history. They want to see stability or that you got some skin in the game. So it's either going to be, you've got to have at least 3 trade lines, 24 months or more. They don't like a lot of late payments. Um, Again, are you putting 3% down the very minimum, or maybe you're the one that's putting 20% down? You've been at your job for 1 month, or you've been at your job for 5 years. All of those things are compensating factors that conventional loans do look at. We do run all our loans through an automated underwriting system, which matches the guidelines to what's on paper on your application. So it will give us a notification if something doesn't work, and it'll tell us why. Where we can help you, if we can, to qualify for that type of loan.
Oh, you touched something about underwriting, so maybe we can talk about that next time. Or what's the
Yeah.
process is like? So, let's go over investment property loan and conventional.
Mhm.
How is that structured in the guidelines for somebody, for example, like me, for example,
Mhm.
I want to get an investment property. So, what's the down payment and everything in and out of it?
Right. So investment loans with conventional, you can do a minimum of 15% down. It will have private mortgage insurance. And then in some cases, it will require 20% down, and it does not have private mortgage insurance. But investors, even if you're buying a property and you're going to rent it, we also have the ability to use the incoming rental income on that property to help you qualify. So again, it's there for people who are looking to rent the property out, not to live in it.
Okay.
But there are programs that can do that. So you can purchase your home, pretty much anywhere. You can have your current home as your primary and purchase another home, whether it's a block away or 50 miles away, as investment or second homes. You can do that with conventional loans.
Okay. So let's say if I currently own a home and then I got myself a second property, then I'm going to live on that the one that I buy as my primary residence. Then my previous home, you will calculate the income that will be in that property for as an income on the loan. Like, let's say if I'm getting 1800 on the rent, and then the second home will be my primary resident. How are you going to calculate that to say that I have an income coming?
Okay, so you're talking about a departing residence. That's
Yes.
a little different than just buying a set investment property.
Okay.
So departing
I think
residence is basically you have a primary left, right? You moved out, or you're moving into a new home as your primary residence.
yes.
So basically what that does is that if you want to count rental income on the departing residence, you're going to have a lease and deposit already prepared for us to be able to count income on that property. And there is a percentage there as well. It's 75% of the rental income coming in. But you would have to have that in place prior to moving. We won't be able to just count rental income on that property just because we want to.
Mhm.
That rule about using rental income is on properties that you're purchasing strictly for investment
Okay.
purposes.
Okay. Okay. So, what is the in the current market? What is your advice for the consumer? Because
Mhm.
people are going crazy over sending out tremendous amount of money on over asking price, even with conventional loan.
Mhm.
And as a realtor, I think it's our job to guide our client to make the best decisions. And we have to looking at the long-term effect on
Mhm.
that property. If it's going to, let's say, a year from now, 2 years from now, and something happen, you want to resell, will you be able to get a return on investment or even sell it for market value where you can pay off the loan? So, what
Mhm.
is your advice for the consumer today?
Well, always my first thing is always going to be that they need to get a pre-approval.
Okay.
So whether they work with me or another lender, it's always the best thing first is to get your pre-approval completed. You need to know how much you can qualify for, what your max budget is, because if you are, and I always ask my buyers as well, what are you comfortable paying? Because I can tell you that you're qualified for 4,000 a month, but you may not want to go that high. So number one, you can know your comfort level as far as what you're comfortable paying, but don't know what your maximum budget can be, because if you do get into a situation where you are paying over price, over asking price, you want to make sure that you're going to be approved for that. And again, like we talked about earlier, making sure that you have the funds available to cover any differences should that arise. So in this market, again, it's good to be prepared, because the houses are flying off the market so
Yes.
quickly that you want to know, again, what is my max budget, what's my tolerance. And then of course, have your pre-approval in hand ready to go, so that you can go out there and shop confidently. Because if you see a house and you like it, 9 times out of 10 you got to put an offer on it right away, because if not, you've got 4 or 5 people coming right behind you that might. And your realtors are going to need your pre-approval letters to submit an offer, so you've got to have that part taken care of first. So be prepared when you talk to your lender. Have your documents ready. Of course, your documents include your 30 days of pay stubs, your W-2s for the last 2 years. You're looking at your bank statements for the last 2 months, and if you're self-employed, your tax returns for the last 2 years. So that way, again, you're prepared when you talk to your lender, and you can help your realtor get that pre-approval quickly, and so they can find you something in that price range that you need to be in.
Okay. So, you touched something about down payment. I know we talk about that. Can the borrower use funds from a retirement account? Um,
Absolutely.
okay.
Absolutely. Yeah, they have to show, just like a bank statement, they'll have to show 60 days worth of their investment account or retirement account. Some of them come quarterly. They will have to show that. They will have to show us the terms of the withdrawal so that we know what the withdrawals terms are. And they will also have to prove, the money coming out and the money going into their bank account. So there are, steps in place. Like I said, we have to verify everything. But yes, they can use investment accounts or retirement accounts as well for that.
Okay. Well, Julia, I appreciate you for again allow me to interview you. Thank you for coming in. And one disclaimer: everything we talk about in previous video and this video is just for education purposes only. Nothing we say here is set in stone. So the best thing to do is to talk to your mortgage broker if you are thinking about a home and you are currently in the market. It's good to get educated, and also it's good to have somebody that have your back. So, Julia, for somebody to get in touch with you, let's say someone is moving out of state or in the state of Texas, what is the best way to get in touch with you?
All right. Well, again, it's Julia Davis with Guaranteed Rate. They can reach me at 832-282-9033. Or they can send me an email. That's probably better. Julia.davis@rate.com.
Okay, so Julia, thank you again. This is Rose with eXp Realtor. Be sure to follow and like this video. We
Yes,
will
thumbs up.
make more video like this, and I will bring in more guests so that you guys can see the in and out of the mortgage industry. So thank you, Julia, and have a good day.
You too. Bye-bye.